and we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important, and the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Fed Chair Jay Powell, they're defending the central bank's independence, even in the shadow of unprecedented pressure from the Trump White House. We're live from Hong Kong. This is Insight with me, Yvonne Mann, where we dive in deeper into the stories that matter with crucial context and sharp analysis. Well, with the Fed on hold as expected, geopolitics are back in play for markets, oil climbing as Trump threatens Iran while gold and silver extend their record highs. Standard Chartered's global head of commodities research, Suki Cooper, will tell us why she sees the core drivers behind the precious metals rally intensifying. The rout in Indonesia stocks, meanwhile, extending for a second day, triggering a temporary trading halt as investors assess downgrade risks and transparency concerns. We get insights from our expert panel. And a massive day for tech earnings, too. Samsung and SK Hynix each reporting record results as the AI wave shows no signs of breaking. Tesla's pivot to robotics also in focus as well. But is it arriving late to the party? We're going to ask Goldman Sachs' head of China Industrial Tech Research, Jacqueline Du. Well, just like that jittery robot just now, dancing one, but certainly markets are feeling a little bit jittery here right now. When it comes to just all the headline risks that we're seeing, we'll talk about Indonesia in just a little bit, but where I think you're seeing the bit of a selling is going to be in Korea, right? Although we're pretty much flat right now, but we have seen quite a bit of reversal after those earnings came through from Samsung, from SK Hynix, which were actually solid results, but investors seem to be pushing the sell button on news here right now. So that's what perhaps is leading to a bit of a negative sort of sentiment in the Asia Pacific, where we're slightly lower here. U.S. futures are flat. Obviously, we've got to get through some of the U.S. tech earnings that we talked to you about, but you're starting to see the winners and losers of this whole AI capital spending sort of trade and where things go from here, right? We take a look at Meta and Microsoft as well. The dollar comments have been interesting from Scott Bessent. Seems to be trying to calm the market after what we heard from President Trump just a day ago, talking about how he's not concerned about the weaker dollar. Scott Bessent said, look, the U.S. still values a strong dollar policy. You are seeing a little bit of that rebound here, but right now, it seems like right now you're still seeing 153 levels for dollar yen, dollar China at 694 here this morning. We'll talk a little bit more about some of the property easing curbs, the curbs easing in China as well. That really is sending some of these developers rallying here in China today. But, you know, front and center when it comes to where you're seeing a lot of free fall is really in Indonesia. If you see in the last 2 days, we're basically extending those losses here. We're down 16% after what we saw from MSCI. It is now under a trading halt for a second day on the back of this warning here. But, you know, it's really tough to find a floor right now, just given the investability sort of concerns that MSCI raised. And, you know, they have to get their act together from now until May. That's a long time here and now. What do you do if you're an investor? We just heard from a guest on the China show saying, look, it's not a macro problem. It's more about the technicals that they have to work out with. And maybe the macro picture longer term is still upbeat for that market. But certainly right now, trading halt right now, we'll get a little bit more details on what's next coming through and what really policymakers can do, can put a floor on this market. The focus, though, we got to still talk about the Fed, with Jay Powell's decision to hold off on an interest cut long sought by President Trump. Now, in his press conference earlier, Powell emphasized that the decision was supported by most of the FOMC, despite 2 dissents from Chris Waller and Stephen Myron.
There was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today.
Well, for more on the Fed's decision to hold, let's bring in our MLI strategist, Mark Cranfield, in Singapore. And Mark, it was a very interesting sort of Fed meeting, right? Coming into it, there was all these subpoenas, question about Fed independence. And I think, Powell tried to at least address those things. But really, this Fed meeting wasn't really that market moving in some ways. You could say it really was more the Bessent comments on the dollar that moved the market. But what stood out to you?
Yeah, it hasn't really done much to move the needle in terms of expectations. Before the Fed decision came out, traders were expecting there was still a chance of 2 more interest rate cuts this year from the Federal Reserve. That hasn't changed a great deal. We're still pretty much there. It's been reduced a fraction, but not by a huge amount. And that's not surprising because there was very limited guidance. And of course, what everybody knows is that Jerome Powell is coming towards the end of his tenure, still waiting to find out who will be his replacement. And traders are assuming that whoever it is that replaces him will be more dovish than the current chairman, and that will still give a chance for lowering interest rates this year, even though some of the data doesn't really justify cutting rates further from here. And there's been quite a lot of pushback from other Fed speakers as well. As you say, there were 2 dissenters who wanted a rate cut straight away, but nobody will be surprised that it was Waller and Miran. They were the people expected to do that. So not a huge amount of signaling out of that. As you also say, Besant is taking much more of the focus, but I think it's a bit of a nuanced stance actually. And if you look at what investors are looking through those comments that he made, and he says that they have a strong dollar policy, but he also said that means that the US has to get its fundamentals right, and that is where long-term investors are probably challenging the US from that point of view, is that a lot of the fundamentals don't align with where people will see it as a reserve currency. That's why you're starting to see money move to the euro, to the Chinese yuan, even to a small extent already to the Japanese yen. And he said that Besant said that the US has to get its balances in order. It has to reduce its fiscal deficit, those kind of things, to persuade people that the US is the right place to put their money back into. Well, none of that is clear cut for the time being. So even though the dollar bounced a little bit, they're starting to erase some of that. And I suspect that as people think about it a little bit more, those comments from Besant will be in the back window pretty quickly, and they will go back to focusing on why the US dollar is probably beginning a long-term downtrend. As Stephen Jen was saying this week, people might be surprised that the dollar smile is only at the beginning stages, and we could have quite a long runoff here for dollar weakness.
Yeah, that's one story. And then what we're seeing in Korea, right? When you're talking about, really robust sort of results that came through from SK Hynix and Samsung, it seems like investors right now are just hitting the sell button on the back of it. The sort of weakness and the reversal that we're seeing in the KOSPI right now, is that likely to spread across the rest of the region today?
We saw it begin yesterday in Europe. ASML had stunning order book numbers. Initially, market took it well, and then the stock actually ended lower on the day. That was a warning signal straight away to people to here in Asia. We've had Samsung and SK Hynix not able really to sustain their recent gains, even though the numbers look pretty good on the surface there. And we've had a slew of big tech earnings from the US as well, and yet NASDAQ futures are a little bit lower as well. So it's looks as though people are getting a little bit tired of this story for the time being. We are approaching month end. Overall, it would have been a pretty good month, January, for risk takers globally, for macro investors. They would have probably had a pretty decent month. They may well be tempted to put some of that money aside for now. So all of these are good excuses for them to do so. We'll probably get a better read when we get into February. But certainly when you've got precious metals going through the roof as well, Korean stocks outperforming dramatically, it's all beginning to look a little bit overextended, and it wouldn't take too much for a pullback there. Whether that's a really meaningful change in direction, we'll only really find out in a couple of weeks' time. But certainly the warning signals are there that in the very short term, it's all looking very overheated.
Mark, what we're seeing some news here is when it comes to China property. So we're seeing the stock gauge basically extending those gains here this morning to more than 8% here right now. This on the back of some local media reports talking about developers no longer required by the regulator to submit a key set of metrics designed to rein in debt buildup. So talking about those 3 red lines. What does this signal to you? Are we finally seeing some sort of easing of some of the property curves that the market really wanted to look at, what was waiting for?
It's obviously been long overdue. I mean, the market there has been under a cloud for a very, very long time. The Chinese authorities used a heavy-handed approach, which really went too far. And of course, it caused all kinds of problems, particularly in the bond market. People having to default and a whole chaos from that. So we probably reached a point where it couldn't really get that much worse. And I just saw headlines going through that you've got some of these stocks up 18 or 19% today, but they're obviously coming from a very, very low base. So you've probably had a situation where a lot of investors would have been ignoring the Chinese property market. So even any marginal positive news will push a little bit of money back into the market there, and it will boost stocks. So Country Garden is trading at 33 cents. So it doesn't take too much to move it 18% on that kind of indices. So it's a positive signal. They'll need to follow through with some more measures as well. But for people to be really convinced that the Chinese market, the property market, is really turning strategically, it's going to need a lot more reinforcement, because that is a market that hurts so many people. So much money was lost, and some people probably would have said we're never going to touch it ever again. So let's see if they can really change it around. But it will need a concerted effort to get Chinese property back on the right footing.
Yeah, as you mentioned, double-digit gains for some of these stocks is quite interesting as well. Mark, thank you. Mark Cranfield, our MI strategist, joining us out of Singapore, walking through all the big themes for us here today. Let's get insights now from Karsten Junius, chief economist and head of economic and strategy research at Bank J. Safra Sarasin. He's usually based in Zurich, but joins us from Singapore today. It's great to have you. Interesting. I'll start with the China news. This report talking about how this removal of these sort of the so-called three red lines. Certainly, it's a headline grabber. I'm just wondering, how positive do you think this is really going to be for the Chinese economy if they follow through?
Well, let's see whether they follow through. We've always been surprised once in a while by headline news, and then on the ground, I'm not sure how much is then really changing. We have these structural problems, the Chinese economy again and again, then some fiscal stimulus, some measures, but overall, well, conditions are largely unchanged quite often.
Okay, so maybe not quite convinced yet, Karsten, but your overall outlook when it comes to China's economy. I mean, certainly last year was, exports that really kind of was the pillar in achieving that 5% growth target. What does 2026 look like to you for China?
So actually, let's come to exports. That is one big positive thing, how quickly the Chinese economy was adapting to this changing environment in global trade. We have seen record export numbers, record trade surpluses. So the ability to adapt is really amazing, and this makes me kind of positive despite all the structural problems that we continue to have, especially in the real estate market. Question is whether the Chinese economy is managing some rebalancing, whether the central banks allows the currency to appreciate somewhat to help with that, and whether deflationary fears are coming back, and how much they would prevent that appreciation of the exchange rate. But the export sector is itself, I think, it's really amazing.
Yeah, and really what's, I guess you could say, underpinning the strength in the currency in China is also this weaker dollar narrative that continues to be, continue to really kind of weigh on investors' mind, because, Karsten, these are some historic moves that we saw in the greenback this week on the back of President Trump's comments. Besant seems to try to cool the markets a little bit, but do you think that changes at all the sort of bearish trajectory of the dollar moving forward?
Now, we shouldn't forget the US dollar is still highly valued. According to our calculations, around 15% overvalued. And I think we are on a trend where we see a correction. Not necessarily a crash, but a softer dollar this year. Could be another 3 or 4%, something around that. But I think the direction is clear, and investors have understood that. Yes, there were comments by Trump. There are other comments by Besant. Officially, they want to have a strong U.S. dollar. I'm not really know whether strong U.S. dollar necessarily means a highly valued U.S. dollar or just an important role of the U.S. dollar in the global financial system. Could be the latter, as that would then also support the Treasury market. But in general, I think once trends have set in, they continue. I hope Europe, it's not a crash. And well, one thing supporting that is that we still see money flowing into the US. Otherwise, we wouldn't get these high or these record high equity valuations that I think we have the S&P just over 7,000. So it's not everyone is selling the US.
Yeah, it's not so much to sell America, but more, I guess some have tweaked, like it's the hedging America in some ways, right? In terms of the dollar, I mean, if you take a look at the fundamentals, the data still looks quite resilient for the U.S. economy, right? It's not really the rate differential story that's driving dollar. Do you think that there still needs to be some sort of risk premium put on the currency, just given the policy uncertainty around Trump? Or do you think that the market is basically just kind of overrun this a bit?
No, I think the market is assessing the problem quite right. We have seen the rupture between the US and Europe that was reinforced, and I think even the last investor should have understood that we are not going back to this closeness in the transatlantic relationship that we used to have for decades. With those political changes come economic changes, come changes in the investment behavior, and also how we hold reserves. We shouldn't forget we hold US dollar reserves because they are safe and they are liquid, and because of the rule of law and the trust that we have in the system. If we lose some trust in the system, in the reliability of the US, in its rule of law, then it's clear that we have to shift savings and reserves somewhere. Unfortunately, there are not many places where to shift them to, and this is why the gold market, the gold is seeing one record high every other hour, it seems. And I think all this makes sense. Otherwise, the US economy is extremely solid.
Yeah. You mentioned about gold. I mean, we're talking about copper now, so it's not just the precious metals, but just metals in general, Karsten, seem to be hitting milestones every hour, as you say, even every day. So we're surging some 5% now on the LME contracts there as we continue this commodities rally. You mentioned gold as sort of probably the few and far between alternatives to, of course, safe havens, the dollar and the like. Is this more than just a tactical sort of trade now? Do you think that there really is kind of a change in the strategic allocation of gold now?
Well, absolutely. Absolutely, and we have to hold other assets. We have to maybe hold commodities, strategic materials directly, and that is also a consequence of these political changes that we see, and that we cannot rely on these US dollar reserves as much as we did before. The point of holding reserves is that in times of crisis or need, you can use these reserves and convert them into food, into commodities, into weapons. Well, in a situation where you're not really that sure anymore whether you can use these US dollars, you hold those commodities directly. So this is why I think we see this run on strategic materials, on base metals, on precious metals, on everything that you need for your economy. So it's a structural shift towards these assets that is likely to continue.
And Karsten, just given the weakness in the dollar, what we've seen, do you think it's already doing the work for the Fed? I mean, obviously they've paused. How long do you think this sort of pause from the FOMC can last now?
Well, thinking about Powell's comment this night, I think it's absolutely clear that he doesn't intend to change interest rates anymore. So the most remarkable or the most important thing that he said is that the risks around his goals, they have diminished on both sides. So lower risk on the labor market, lower risk on inflation, and this is why he feels so comfortable about the current rate rate level. We believe that we only see one rate cut in the second half of the year, as we are more or less in this reflation camp. We have fiscal impulse kicking in the U.S. economy, as in other economies as well, and that means that well, first the economy remains strong and solid, and inflation is probably only softening well, slowly, step by step. Hence, it takes more time until a rate cut would be justified.
Karsten, it's good to have you here in the region. Karsten Junius of Bank J. Safra Sarasin joining us out of Singapore there. We got plenty more ahead. This is Bloomberg. Well, we're tracking shares of Samsung and SK Hynix in the back of those blowout earnings from both memory chip makers, fueled by continued robust demand. For more, let's get a more bit of analysis from Bloomberg Intelligence senior industry analyst Masahiro Wakasugi. He joins us now from Tokyo. Masa, it's always great to have you. It seems like these earnings calls have wrapped up. I mean, these were blowout numbers. What stood out to you really this time around?
Yes, we had two conference calls in this morning, and I think that we found that the memory demand should be quite strong in 2026 because of the AI demand. So I think that this trend should continue going forward, and even in the first quarter, normally we have a seasonal adjustment, but it seems like pricing should be fine, and even the volume should be quite nice even in the low season. So and both companies achieved pretty nice earnings because of the average selling price increase in Q4 in the December quarter. So it's not like up 5 or 10%, but something like up 40% for the Samsung DRAM ASP, and 30+% ASP increase for SK Hynix. And we don't know how much price increase should be the potential one in Q1, but we should be able to expect a pretty nice ASP increase for the Q1. So I think that should be the major takeaway for the earnings call.
A lot of concerns in the market have now been the constraints around memory chips, right? In terms of the supply shortages and the like, how do you think these companies addressed it? And how big of a bottleneck is this going to be now?
Yes, so if we remember the demand for the both DRAM and NAND 1 year ago, and especially for the conventional, the standard ones, we didn't have a very strong demand for these conventional standard ones. So a company was not aggressive to expand capacity. So this kind of tightness should continue into maybe this year. And Samsung, SK Hynix talking about multi-year contract based on the current strong AI demand. So I think that maybe memory companies cannot expand the capacity so suddenly. So we think that maybe company have to probably expect some weaker demand for the low-end smartphone or maybe low-end PCs, where PCE have the higher cost from the memory chips. So, but it seems like demand from AI is pretty strong. So
Masa, we gotta leave it there. Masahiro Wakasugi there joining us from BI. We got plenty more coming up here on Insight.
And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI.
Fed Chair Jay Powell, they're speaking on how AI may be changing the job market, and really this quarter's first big tech earnings out of the U.S. really underscore the sort of mixed approach to this whole AI boom. We have Microsoft reported record spending and a slowdown in Azure growth, setting its shares sharply lower despite that solid rise in overall revenue. Meanwhile, Meta beat expectations with strong holiday quarter sales, and its stock jumped as the company signaled even bigger investments ahead of a build-out of AI infrastructure. Over at IBM as well, software strength powered double-digit revenue growth and really helping the company forecast steady expansion this year. And bookings for IBM's AI business have exceeded $12.5 billion since mid-2023. So together, the results show an industry that is booming, but not all companies feeling that momentum the same way, and whether we are actually getting those returns from, of course, this massive, relentless capex spend. In fact, when it comes to Tesla, known until now as an EV maker, well, it's planning to spend $20 billion this year to streamline its vehicle lineup and shift resources towards robotics and AI. And it's part of a sweeping set of changes, pushing the company further from its roots. Let's get to our Asia tech reporter, Annabelle Jewelers, that joins us now. Yeah, it's not just an EV company, for sure, when it comes to Tesla. But yeah, what are sort of the ambitions that we're talking about?
No,
here?
It really hasn't been for quite a while now. Yeah. But some analysts we spoke to for this were saying this is really the quarter that marks the fundamental shift from an EV company to one that's pursuing more future-focused initiatives, specifically when it comes to robotaxis and also to humanoid robots as well. And so you mentioned that capex spend of $20 billion this year. That's more than double what analysts, or roughly double what Wall Street analysts had been expecting, which I think is quite exceptional. And it's interesting how markets are interpreting that as well, because you saw stock trading up nearly 2% higher in late trade, but capex was such a big focus across all of the different companies in this reporting season, but being dealt with in different ways. So you mentioned that drop, for instance, you saw a Microsoft, Meta, though, faring better. But where that capex is potentially or specifically going to be going to is really to building product expansion or production expansion, rather, at multiple factories for Tesla as well, and then scaling up that robotaxi business and building out their AI infrastructure as well. They mentioned, although not attached to this capex, but plans, for instance, for an AI chip factory, given that they're saying that is one of their bottlenecks. Actually, memory chips also more significant bottleneck for the company in the near term, but clearly they are moving in a more tech-led direction.
Yeah, BI had an interesting take on just how long it would take Tesla to have a very commercially ready Optimus robot, which is still, Steve Mann says, at least a couple of years away. I mean, now you're seeing the technology that's emerging out of China. I mean, it's already starting to see some shipments and maybe industrial use. Is Tesla just going to be a latecomer in this already very crowded market?
I wouldn't say latecomer. I think that the Optimus robot is often recognized even by Chinese humanoid companies as being an industry leader. Where they really excel is more on the software side. In particular, I think the real advantage of Chinese humanoid companies that they have is more on the mass production capabilities or the manufacturing expertise that they have in terms of more of the hardware side of it. I mean, you really can't compete with China in lots of different areas. But at the same time, the Optimus product is very competitive. It's, as I said, it's routinely seen as or recognized as an industry leader, and of course, given that you see even broader bifurcation between the US and China, there's going to be lots of different businesses or companies or governments that will only want to work with a US product as well. So they still, of course, have a major market, but yeah, I mean, Elon Musk is someone who said that needs to be a bit patient. Investors need to be a bit patient as they move into this direction, and he's asked investors for that. But in terms of the near term, we still saw, just to mention, adjusted earnings per share 50 cents in the quarter. So that was actually better than what analysts had been expecting as well. So overall, the numbers weren't too bad, because you're basically snapping a string of 4 quarters in which profit was weaker than expected for the business.
All right, Belle, thank you for summing that up for us. Our Bloomberg Tech co-anchor Annabelle Jewelers there. And of course, as we await the mass production of Tesla's humanoid robots, Chinese competitors have already been shipping thousands of units around the world. So will Elon Musk's Optimus, as we just talked about, end up late to a crowded market dominated by plenty of Chinese brands right now? Let's bring in Jacqueline Du and bring that question to her. Head of China Industrial Tech Research at Goldman Sachs. She recently visited several AI robotics-related companies in China. So it was a big visit that you had there. Tell us a bit more about some of the takeaways that you got and what really impressed you.
Yeah, my biggest takeaway would be, I think heading to 2026, my own prediction would be likely we'll see increased pilot deployment. Or we wrote in the reports, we think there's likely a multi-fold growth in terms of shipment volumes. But of course, the industry is still in a very nascent stage. Let me give you some numbers.
Sure.
I think last year, the whole industry, globally, probably shipped about 15,000 units of robot. And the bulk of that is actually coming from China. As a reference, industrial robots currently, the annual shipment is 500K globally. So human robots actually just 3%. It's very tiny. So likely we're going to see fast growth from a very low base. And last year, let me elaborate. The detailed demand is coming from, for example, scientific study, AI model training, education demand, and also stage performance. You probably saw that. And also,
dancing.
Yeah. And there are, I heard there are hundreds of data factories in China currently under planning or under construction, and they need to purchase robots to gather the data. So that's where the demand is coming from last year. But into 26 and 27, what's different is, I also wrote in my report, I think there's a clear pivot towards dedicated purpose robot, meaning inside shopping malls, museums, etc., you will be able to see robots doing shopping guide, tour guides. So that's the increasing demand.
Where do you see the gap now between Chinese innovation versus some of the foreign names that we talked about, maybe Tesla included? Do you think that gap is narrowing now in terms of the technological sort of breakthroughs?
I think U.S. and China, each country actually brings their own distinct strength. Where the U.S., they're leading in terms of a foundational AI robotics research and capability. And they also have this very robust AI ecosystem and a very vibrant venture capital environment that's attracting significant funding for many startup companies. So that's their strengths. But at the same time, they will probably face challenges in manufacturing and supply chain, especially when it comes to cost effectiveness or as efficiently as China. So that's the positioning for U.S. And on China's side, I think the development progress has been fast. Of course, China has this unparalleled manufacturing strength and also extensive supply chain, but at the same time, it probably lacks this foundational AI capability.
Yeah.
But of course, it's a big market. That means it can potentially generate immense amount of data for AI training purpose with the government support. So that's the relative standpoint.
I think Junius mentioned that too. That the challenge with large scale deployment is the lack of really AI models right now. Do you see that changing anytime soon?
Of course, that requires time. I think this highly dexterous, true autonomy, general purpose robot is still multiple years away. But in the near term, there's still something you can do, those robot companies they can do. Why I think the volumes for dedicated purpose robot will start to kick in is because due to this technology limitations, it's difficult to come up with sophisticated algorithm and to really make the robot adapt to completely new environment. But let's say if it's like a shopping mall, it's a museum, relatively speaking, it's controlled environment. And it can do pre-mapping, and the interaction is rather simple. Just think about the functions. This is basically provide product information and to guide you to a certain place, and also to answer some FAQs. It's not too difficult, right? So basically those companies, they can leverage the existing capability and with manageable engineering challenges.
And they're going to need the high-end chips as well.
Correct. Of course.
Do you feel like this what we're seeing globally in the memory chip business, is that going to be a big bottleneck for a lot of the companies that you visited?
The major chips inside a robot is mainly the NVIDIA Jetson Thor chips.
Okay.
And that's the mainstream choice at the moment. But indeed, we're seeing, during the trip, we're seeing many Chinese human robot players, and they mentioned this diversified supply chain strategy. I think it's a trade-off between longer-term self-sufficiency, but they probably need to consider near-term performance. What I mean by that is This also correlates with the near-term volumes contribution. This is coming from dedicated purpose robot. It's simpler. You don't need the so complicated, high-performance, cutting-edge chips to perform those tasks. So near-term, there's a volume for, roughly speaking, low-spec chips. And given time, based on that volumes, with the robot company generate revenue, iterate their product, maybe given time, there's a pathway for them to improve.
Okay, so more of a pragmatic approach, as we always talk about when it comes to some of these Chinese manufacturers. But it's interesting, right? I think last year it was the NDRC that did flag some warnings about how crowded the space was getting, right? Because when they flag more than 150 firms that are basically making very similar robots. Are there bubble concerns? Do you think that investors need to really kind of focus on? And do you think those are justified?
The industry is still in nascent stage. Many of those supply, it's not effective supply yet. And I do believe there's a rationale to prepare capacity in advance. But eventually, I think it comes to the question, what's the positioning of your product? What's really the targeted application, and what's the purpose of the robot? Therefore, it requires very specific hardware design to work well with the software. If the requirement is on a highly dexterous general-purpose robot into the future, then that means there's a very high requirement or entry barrier on many of the components, including different types of tactile sensors, including, for example, the batteries. You need to think about this thermal problems and the durability of the batteries. And then it comes to the hands, right? Yeah. How dexterous the hands can be. I don't think many of the supply out there can really meet those type of requirements. So the point is, what's the positioning? What's the product they're targeting at? And then what's the longer term goal, whether the supply can really meet the requirement?
Yeah, I mean, who do you think is going to emerge as the winners then, right? When you're talking about so many, and I think a majority of them don't actually make money right now. But the valuations of some of these companies, I think we're trading like 60 times earnings right now. Does it justify that sort of valuation? Are they going to be able to deliver that sort of high growth expectation?
First of all, many of the companies currently, they're in the private market. They're not public yet. But I think for investors to think about into the longer term, what are the companies likely to be successful in this market? I think there are several factors to be considered. One is, of course, strong R&D capability, AI capability, right? And two, mass production capability and robust supply chain. And three, I think they need to have this clear commercialization strategy. And four, probably they need strong financial backing, which leads to sustainable development and for them to cope with the competition going forward.
What about in terms of trade tensions? Do you think the geopolitics that are going around, I mean, this is very sensitive technology, obviously. Do you think that's just going to limit China's access to global markets with these robots?
I think eventually it depends on how good a product is. What are the problems they're really solving? If it is helping to address the widespread labor shortage problems globally, there's a value proposition, right? No matter where the robot product is coming from. But indeed, I think inside a robot, there are many components. For example, the sensors, the cameras, they capture data from time to time. Therefore, indeed, there might be potential risks surrounding security, those issues.
Okay, and you mentioned in terms of the investment implications. What does that mean then? How do I start picking out some of the winners and losers right now? How selective do you have to be in the space?
First of all, it comes to market excitement. Even though we talk about currently the volume is only 15,000, it's very tiny, but the market debate is whether it can reach 1 million units as targeted by Tesla. And into the future, whether this can be like tens of millions like cars or hundreds of millions like smartphones, right? So that's a debate in the market. But for a period of time, we don't see this inflection point that's coming. That still takes time. But when we do the back test on the share price implied valuations, probably a really like a 3 to 5 years outlook is already baked in the current share price. Therefore, at the current level, I would tend to see either we need to see a correction for more attractive valuation, or two, we need to see breakthroughs in terms of AI model or data strategy for us to have stronger visibility on the longer term potential.
Okay. Last question. I mean, in terms of application, you mentioned some examples, but where do you think we're going to see the most application when it comes to these robots in our daily lives? And at what point do you think this can actually move from industrial use to something more of consumer-driven?
I think the pathway in my mind would be in the near term, 26, 27, dedicated purpose robot for shopping malls, museums, auto dealer stores. There are many those type of application. And then I think the longer term vision is for the robot to address labor shortage problems. For example, for logistics and also warehousing, healthcare, elderly care driven by aging population.
Sure.
And then eventually the really longer term goal is for household applications. But that's very demanding in terms of complexity, you can imagine, and also higher requirement on safety.
And where does Tesla fit in all this, you think? Are they late comers? Are they still going to be, driving a lot of the innovation? I mean, how do you see Tesla fit into the whole story?
Not specific to any companies, but I think for a big company, tech company, auto company, if they enter into the competition, the market they're looking to is definitely, they have this longer term approach to look at it as compared to the startup company. They need to generate revenue immediately and to support them to reiterate the product and gradual growth. So that's a different approach.
All right. Jacqueline, it was great to have you. A fascinating sort of topic, of course. And of course, we love seeing the video of robots there. Jacqueline Du, head of China Industrial Tech Research at Goldman Sachs. It's all about the dexterity, as she says. Taking when it comes to some movers in this market, it's really going to be the China property space here as well. So there was this local media report about them easing the so-called 3 red lines. And that's enough to see, 20% gains for some of these developers like Country Garden, Sunac China, Shimao Property, obviously coming from a low base, but certainly that's enough to spark some optimism here. Perhaps one of the weaker parts of the economy still remains this property market. So potentially we're seeing maybe some easing coming through. And in terms of the metal space, obviously we saw copper. That was the big one here this hour, reaching records there in London. Of course, as we continue to see this commodities rally, we're still punching above 5,500 for bullion, and silver prices are also north of 117. So certainly it's that debasement trade that continues for another day here as well, and that's despite what we saw from what Scott Bessent mentioned here and trying to at least reverse some of the moves in the dollar in the last 48 hours or so. In terms of India, we're watching, of course, currencies, record lows when it comes to the rupee here this morning. So certainly we're watching very closely there how this all fares. I mean, obviously, passing 92 is certainly going to be a milestone here, and we're watching very closely what comes next. But right now, the dollar at least rebound is actually fueling this trade here right now. Coming up, tensions spike and oil rises as President Trump puts Iran on the clock, warning of far tougher strikes unless they make a nuclear deal. We have details coming up. This is Bloomberg. We were checking Indonesia here this morning, still under a trading halt, but certainly it has been a blistering sort of sell-off here. We are now down about, 5% for the day before that trading halt, but now you tally up the losses of the last 2 days, and we're down double digits here, of course, after the MSCI warning about the fundamental investability issues here right now. We'll continue to watch what happens, the fallout there as well, but certainly they are asking, at least MSCI is concerned, for some sort of reform by May. We're still only in the end of January, so we'll see what comes up the next few days, but really how to provide a floor for this market. Let's talk a little more about geopolitics here, because oil has been moving and trading around those 4-month highs after President Trump threatened an attack on Iran, urging Tehran to negotiate a nuclear deal. Let's bring in our chief Asia correspondent, Rosalind Matheson, joining us now. Roz, so is a U.S. strike imminent? I mean, how likely are we likely to see some action from the U.S. now?
Well, we do see senior officials, including Donald Trump and Iran, seemingly shouting at each other on social media in capital letters. So obviously a lot going on. And Donald Trump has moved military assets into the region led by the USS Abraham Lincoln aircraft carrier. So he does seem to mean business. He has changed his mind, though, in Iran before. Of course, there were the strikes that we saw last year, but since then he's threatened more action and then changed his mind. And he's linked it to different things. Previously, it was the crackdown that the regime was conducting at home. Now it's saying that he wants to get Iran back to the table to negotiate a nuclear deal or else, because there are signs that despite the US saying that those strikes last year decimated Iran's nuclear infrastructure, that its enrichment remains, its capacity remains to some extent, and possibly it could restart its program if it wants. So obviously the US is watching that closely. But all these things are going to be a very careful calculation for the US. Tehran says if you come at us, we will strike back at you. They're obviously trying to enlist other countries in the region to back channel the US to warn them off this course of action. But certainly placing those military assets in the region does give the US the option if they so desire.
And in terms of what does this mean in terms of some sort of deal? I'm just wondering what still needs to be discussed. What are still some of the sticking issues? I'm just wondering, how likely are we likely to see some sort of nuclear deal with Iran now?
Well, that's the question, because Donald Trump's not specified what he wants to see this time from a deal, and he's changed his mind about the parameters of it before. Is that Iran has to stop, abandon entirely nuclear enrichment? Is it that it needs to abandon its ballistic missile program? Is it to stop funding its proxies in the region? Of course, many of those proxies are being significantly weakened over the past 18 months to 2 years, including Hamas and so on. And, is it all of those things that he wants to see from a deal? I mean, Iran insists that their goal is not to build nuclear weapons, but obviously, the UN watchdog says they do retain quite a high stock of enriched nuclear materials, so the option potentially is there. But what does the US want to see from a deal? What would be acceptable? Is it all those things they want? Is it some of those things? It's very unclear. I mean, Iran says we're willing to negotiate in a prudent way. There do seem to be some lines of communication open between Tehran and the US, but exactly what Donald Trump is looking for here, well, that's a bit unclear at this point.
Right, and of course there's been sort of a communications blackout in Iran itself. What do we know at this point in terms of protests and what's really happening on the ground now, Roz?
Well, obviously there was a very extensive crackdown. We know that, human rights groups and even the regime acknowledging that lots of people were killed as part of that very violent crackdown and potentially executions that were going on, in the sense that a lot of people got rounded up as part of that. So you're not seeing evidence of wholesale demonstrations still going on. But interestingly, the spark for this, of course, was the plunge in the currency and the concern around the vulnerabilities of the economy. And we're seeing a fresh move, of course, in the currency. Again, you're seeing weakness there. So perhaps does that bring that back to the front of mind for people? Do they start to come out and protest again?
Yeah. Roz, thank you. Our Chief Asia correspondent, Rosalind Matheson, there. Still ahead, we're discussing the relentless precious metals rally with Standard Bank's Suki Cooper. And later on, we'll hear from former Italian Undersecretary of State with a push for free trade deals outside those Trump tariffs. Welcome back. You're watching Inside. In terms of market checks right now, looks like we're doing a little bit better in terms of risk here this morning. You're actually seeing Kospi after a bit of a wobble there when it comes to that reversal. We are actually seeing Kospi up about 0.9%. Topics and Nikkei are pretty flat right now, but certainly there's a lot of topic discussions around Jakarta and what we're seeing in the JCI here. We're seeing another day of relentless selling there in the trading halt that's happening in Jakarta this morning. So for the time being, it seems like the dollar is on a bit of a back foot here. here. Obviously, this historic move that we saw in the dollar, we saw, on the back of Trump's comments, you did see Scott Bessent try to at least calm the mood of currency traders out there. But it seems like right now, dollar's still heading in the opposite direction. In fact, dollar yen, take a look at that. We're now sub 153 levels and back to around 152 as well. Interesting to know about the rupee, though. We are still seeing record lows there and breaking below that 92 level for the Indian currency. So certainly that's one thing to watch. Your Brent prices are also a bit elevated here, given some of the concerns around Iran and what President Trump said about, they're ready to strike again. So certainly there's some geopolitics in the fray. There's some technicals when it comes to Indonesia. And of course, we still got to talk about what this means with this dollar and debasement trade here. And the big swings we've seen in the greenback and the gold's breakneck rally. Let's bring in Garfield Reynolds, who leads our MLive coverage in Asia. Garf, it's interesting, right? You talk about how close it was for us to get to these levels, right? 30% rally this month for gold. It's double that for silver. How vulnerable are we to a pretty violent sort of reversal now?
Well, there's a lot of nervousness out there, and I think we are vulnerable to some pretty steep reversals. On the other hand, historically, we're at the kind of gains that we saw heading into the blow-up that came when the Hunt brothers tried to corner the silver market back end of 1979 and going into 1980. And then once they got margin called, everything unwound very, very dramatically, very, very rapidly. Now, we don't have any obvious efforts to corner the market now. We also don't have the potential for some Volcker-style monetary tightening, which helped to send metals down back then. We do have a lot of nervousness that this sort of gain is unsustainable. And sure, you've got central banks buying gold, you've got concerns about the dollar and about other fiat currencies. You have some solid reasons to buy gold, but a lot of what's gone on in the last little while looks so clearly like momentum selling. That's the sort of thing that sent GameStop soaring or Bitcoin soaring, and all of those sort of moves ended up with a very nasty come down at the end of it, especially when you look at silver and its even more extraordinary gains. So that's a worry, especially because people get drawn into this by the size of the gains, and then all the time they're wondering when is the time to pull out, and they don't want to be the last ones to leave. They're aware of the history that when this kind of bubble pops, you can end up with decades of losses if you didn't get out in time.
And what would be sort of the trigger for that sort of correction, Garf? You talked about some historical references here, but in terms of near term, sort of for reasons that could derail this rally, what do you think that could be?
Well, I mean, one potential would be if there was a squeeze higher in the US dollar. You think of how Donald Trump helped to set off extra declines when he doesn't care about it. If he was to come out with a serious measured statement talking about how he would like to see the dollar climb against major currencies from where it is now, maybe even said he doesn't like to see the dollar weaker than $1.20 a euro, something like that, something that would get the market's attention. And the market is very, very overbalanced going short US dollars. Something like that, that could send gold as what's been the biggest expression of dollar weakness. That could send gold dropping. It could also be, as I said, momentum has been a major driver. So at some stage, we're going to have a decline, another set of serious declines, which we had late last year also, and that just served as a reboot. The expectation would be that any big drop back down now would also serve as a reboot. But what if it doesn't? If you get the momentum turning the other way, you might not need an actual news trigger. The final one that could come would be if you see some serious slowing in central bank purchasers. If central banks sort of say, well, look, we have been buying, but it's actually getting really expensive. And in fact, we're starting to get to a situation where we find that our reserves are getting overbalanced towards gold. So they're unlikely to come out and specifically say that. But if it sort of seeps into the consciousness that central banks are about satisfied on the gold front, I'm thinking particularly of the Chinese central bank and the Polish central bank and some others, that also would be the sort of shock that could set off a major decline.
Garfield, thank you. Garfield Reynolds there, who leads our MLive coverage in Asia. Our next guest expects further record highs for gold this year, but thinks prices might be vulnerable to corrections in the near term as well. Let's bring in Suki Cooper, Global Head of Commodities Research at Stanchart Bank. Suki, it's always great to have you, especially on a day like today. Yes, so in terms of indicators, what are some of the ones that you're watching right now on whether what Garfield mentioned, right? Are we prone to some sort of correction in the near term?
From a technical standpoint, that normally offers good guidance in the near term, and we can see that much of the complex, including gold, is trading in overbought territory. But the other factors that we like to look at is where does the physical market support prices, and we haven't had a chance to test where that floor is. Now, we're in the midst of a period, we're leading up to the Lunar New Year, so we typically do tend to see good demand coming from China. If it's a solid year, that demand tends to materialize 6 weeks ahead of the Lunar New Year. If it's a weak year, it'll materialize 2 to 3 weeks beforehand. We're now coming towards the end of January, so we're in that period where we tend to see quite good support coming in, seasonal related buying. So on the one hand, we think that one of the near-term indicators we need to track is where does the local premium in China trade after the Lunar New Year? Does it turn negative? Do we see some of that support starting to ease? But I would agree with what has been said. The two big factors that have really driven this rally have been the central bank buying, and then at the start of 2025, the rapid increase that we saw across ETFs, which didn't climb to record levels in terms of inflows, but in terms of AUM and in terms of tonnage holdings, hit a record high and continue to do so this year. So some of the indicators that we're tracking in the near term are around whether we're seeing some of that physical market tightness easing, and we have seen stocks stabilizing in the US. We've seen stocks in London starting to rise again. They've been replenished, but the physical demand from India and China, whether that remains robust in light of these record prices.
Okay, so we have to see if that premium in local prices, does that continue after the Lunar New Year? That's quite key, Suki, because we start to see, right, that Chinese retailers are increasingly speculative in them driving up these local prices. Some funds have also halted subscriptions as well. I'm just wondering, what does that signal to you, and what's the advice to retail investors now?
Looking at the retail demand is a little bit more difficult because we don't get that same real-time data that we do with, say, tactical positioning or the ETF flows. When it comes to ETF holdings, a lot of the growth that we've seen, a lot of the rapid growth that we've seen has actually come from Asia and some of those China-listed products. And that demand is a reflection of the underlying retail appetite in the space. The concern on the retail side is whether it will, typically in China, we tend to see that it lends itself into a rising price trend, whereas in other regions, a higher price tends to dampen some of that appetite. But what's been interesting is that this isn't a story that's centered around just one region. It's not just one country that's driving the demand for gold. It's on a global basis, whether it's concerns around fiat currency debasement, or whether it's concerns around confidence, or concerns around geopolitical risk, or concerns around inflation. It's been different factors on a regional basis, but the demand has been strong across the globe.
Yeah, I think the gold side of things, I think people are still quite optimistic about. I think I get a little bit more contrary reviews, or at least a different opposite view when it comes to silver, right? Just given how relentless that rally has been. How concerned are you on silver, Suki?
I'd say relative to gold, there's more concern for the silver market. Here, there's a huge component that is driven by industrial demand. And our estimates suggest that industrial demand started to decline in 2025. And with prices now surpassing $100 per ounce, more of that industrial demand is likely to come under pressure. How quickly it can switch is another question. It might take a little bit more time. But as we saw in 2011, when prices then reached $50 per ounce, once that R&D kicks in, we can start to see switching or thrifting, this lower content of silver components per solar panel, for instance, can start to accelerate in terms of how quickly it will substitute. So one concern is on the industrial side. The other concern is around scrap supply and whether we can see an increase in supply being motivated and being driven and helping to fulfill that shortfall in the market. What's been interesting here is that, yes, there has been an uptick in scrap, but it's been absorbed by the market. So the demand is very strong there. But for the silver market, because there is that larger component on the industrial side, that makes it a little bit more risky, because we know that silver tends to outperform when both industrial demand and investor demand is very strong. And right now, a lot of the growth has come from ETFs. Having said that, we have started seeing net redemptions accelerating in January when we look at the silver-backed ETFs.
Okay. So in terms of silver, where do you see prices are manageable? I mean, or at least where do things settle, you think? If in fact, in terms of, where do you see that level now?
We did expect prices to surpass $100 per ounce, but we reached that level much more quickly than we had anticipated. We're now looking at some of the factors that had been tightening the market, and one of those was around the Section 232 Critical Minerals Report, which confirmed that there wasn't going to be any additional tariffs released in the near term, and that has seen COMEX inventories starting to fall. So some of that market tightness is starting to ease across the silver space. So it suggests that a lot of the upside momentum we're seeing now is really being driven on the retail side, and we know silver prices can be quite volatile and they can correct quite quickly as well. So we do think that there is scope for more upside risk. We still think that we're going to see a market that's undersupplied this year. It'll be the 5th straight year of a market deficit. But the real tightness has come from the physical market. And these are all hard assets. There are physical markets, and that is starting to ease. So we think that we could see a correction in the silver market that would also be a healthy for the longer term trend.
I know your global commodities now. How should I be looking at maybe beyond just the precious metals rally, right? You're seeing it in copper prices that have reached records again. Tin, we've talked about these kind of non-ferrous metals that are doing and having a great field day as well. I mean, how should I be looking at some of those rallies too now?
Some of the macro factors have been supporting the broader complex as a whole. When we see the dollar weakening, it does tend to provide somewhat of an uplift for the complex. But what's been interesting here is that some of these traditional relationships, i.e. if we look at gold and the dollar, have started to weaken. So typically we can see the gold-dollar relationship being quite strong, and it tends to be quite a good indicator on a short-term basis. But that correlation has actually quite weakened substantially, and we saw the dollar index falling to levels that we last saw in 2022. But the concerns around fiat currencies has helped to lift the complex as a whole, and this desire for hard assets has supported investor appetite across the space. But for copper, we see a different dynamics unfolding here. Initially, yes, there was a lot of focus on the demand side, but we saw last year some of the supply constraints starting to kick in, and some of these mine disruptions were at major mines, and particularly here when we look at Grasberg. And these are disruptions that have continued to spill over into 2026. So yes, we have seen record prices in the copper space, but we think a lot of that upside risk has already been built into prices, and we're more likely to see it being concentrated in the first half of the year, with prices started to ease in the second half of the year when some of these supply challenges start to ease. But once again, it's been a physical market tightness that's been driven by regional dislocations. We saw a significant build in COMEX stocks of both copper, silver, gold, and the platinum and palladium metals as well. So some of these concerns around tariffs and trade tensions has really materialized in regional discrepancies.
Okay, last question. I forgot to ask you about where you think gold's going to be. I think 5,500 was your year-to-date high that you thought we were going to hit. It's only January 29th. I'm wondering, are you looking to upgrade your forecast for gold anytime soon, or are you staying put?
There are upside risks to our price forecast, especially as we've reached that intra-year high that we had been anticipating to materialize later in the year. But we're cautious in the near term that we think prices do need to moderate in order to continue to build on a healthy rally over the longer term. So we would be really looking for how the physical market reacts over the coming weeks, especially after the Lunar New Year. And we're looking to see how the ETFs continue to respond. So far this year, we've continued to see a strong build. We're up 75 tons for the year to date. data already, but we need to see continued demand from the central bank side and ETFs continuing to support that upside. We think a lot of the structural secular drivers, those core factors behind the gold rally, still remain intact and in fact have intensified. So there is upside risk, but we think that the gold rally would benefit from a correction in order to maintain the upside on a longer term basis.
Suki, great to have you. Suki Cooper, Global Head of Commodities Research at Standard Chartered Bank. Still ahead on Insight, Indonesia's stock rout becomes its worst since 1998 after MSCI's warning over investability. We'll look closer at the outflows next and ask what can be done to stem the bleeding. Much more ahead. This is Bloomberg. Well, we're talking about Indonesia. Now stocks have plunged deeper into turmoil with MSCI's warning over market investability, sparking the worst two-day rout since 1998. Now, foreign investors had already turned cautious as President Prabowo's move to elevate his nephew to a top central bank role raised fresh questions about monetary independence. To break it all down, we're joined by our markets reporter Abhishek Vishnoy and our Bloomberg opinion columnist Dan Moss. Abhishek, I'll start with you. It's a second day of a free fall, really. What's to come? I mean, we've already seen trading halts. How do we put a floor to this?
Well, the floor can come only when government comes out and intervenes, or investors starts believing into what the local regulators are saying in terms of what they'll do to assuage MSCI's concerns. But for now, like you said, 2 days, 2 halts, and significant price pressure. It obviously looks like a regime change. It obviously looks like investors want Indonesia to trade at very low valuations. Just from a gradual sell-off kind of thing, this is now turning into whether the Indonesian assets have some kind of toxicity. If you look at the price action and the reporting that we are doing, a lot of EM funds were still overweight on Indonesia by the margin. So it's not just about the passive outflows that a lot of sell side have talked about. Active money is also looking for other homes. We have been told by a lot of fund managers that if the mandate is ASEAN, money might chase stories like Singapore, where a value of program is going on, and if it's EM, money might look at China-related stocks or those listed in Hong Kong with a China angle. So overall, it looks a pretty negative setup and very akin to sort of a structural de-rating, very similar to using Indonesia as a funding short to take exposure elsewhere.
Dan, I'm going to bring you in on really kind of the source of all these sort of concerns about investability. You wrote a column this morning talking about Nepo babies that are, hurting Indonesia's economy. And you're talking about, of course, Prabowo's nephew that was elevated as the central bank's deputy governor just a few weeks ago. Tell us a bit more about the concerns about central bank independence now in this economy.
Sure. So what our colleague Karishma Vaswamy and I were really trying to get at in that column is not so much the MSI specific issues, but the growing sense of unease about decision-making in Indonesia since President Prabowo's term began, and the people that are making those decisions. We've seen a steady and unnerving erosion of what might be called the post-1998 settlement, at least as far as the economic sphere is concerned. Two principal of that: one, an independent central bank, and two, rules which are meant to provide some insulation of monetary policy from fiscal policy. The new finance minister has emphasised, to his credit, the importance of independence. In the very next breath, he typically said, we want to see more coordination between the central bank and the finance ministry. There's only so much of that you can do before independence becomes a name rather than substance.
Abhi, we just spoke with an analyst with a bit of skin in the game here. This is Mohit Mipuri, senior partner at SGMC Capital. He talked about really how, what he's looking at right now in this market. And he hasn't really done too much in terms of his positions here right now, but I just want you to take a listen to what he had to say.
There is no realistic risk of Indonesia being downgraded to frontier market status. We have to remember it's a G20 economy. It's the largest equity market in ASEAN. This is about index methodology fine-tuning. It's not a judgment on the country. So I would definitely be stepping in and I will not be reducing my exposure to Indonesia.
Yeah, Abby, it seems like he flagged this is not a macro sort of story. This is more about technicals, about free floats and the like. That it doesn't change his long-term view of Indonesia. When you talk to a lot of the analysts, and your sources, do they share that sort of similar sort of position now?
Well, if you look at the price action, I mean, it does change the position. Economy might not be a frontier economy, but clearly investors are buying into the idea that there is a risk that Indonesia might be downgraded, at least by the stock index providers, who, by the way, passively are probably the biggest fund managers, to a frontier market status. And, there is a vicious cycle in play. I mean, lower asset prices means lower prices at which you will raise funds, weighing on business sentiment, and maybe even, opening gates towards a credit downgrade. So this is becoming really scary. The thing to note here is, look, this is led by MSCI, this is led by FTSE, but these are high liquidity, very high impact events. And what they've done is, apart from free float concerns, what they've done is they've underscored the gamut of things that are going wrong in Indonesia, the thing that Dan Moss was just talking about. So all in all, if you look at this picture, macros are not looking good, medium-term outlook because of passive flows are not looking good, and therefore long-term money is exiting, and people on the long short side have started using Indonesia as a funding short. You saw this somewhat of a similar cycle happening, in India, where a lot of outflows have happened and they're looking for home elsewhere because there are relatively better opportunities. So why to take risk in a market which is very expensive? You're seeing something similar in Indonesia. And we have to take a note of this thing. China used to trade with 30% weighting. There were some structural issues after COVID zero policy flip-flops. Investors did not absolve China at that point in time. There was a question about its investability. China is EM's anchor, possibly even world economy's anchor. When you cannot absolve China of this, why would they absolve Indonesia, which is just a 1.1% weighting in MSCI EM index?
That's why you're seeing Goldman, UBS cut the recommendations on Indonesia there, and even Goldman citing $13 billion in outflows that could be triggered here as well. Abby, thank you. Abhishek Vishnoi from our Bloomberg Markets team. Also, Dan Moss, Bloomberg Opinion, on really what it means for the economy. Coming up, we talk about UK Prime Minister Keir Starmer's meeting in China next. This is Bloomberg. Welcome back. You're watching Insight. Well, we're doing a market check here right now, and you continue to see when it comes to Asian equities. We're catching a slight bid here this morning. Kospi, we're off some of the initial highs here, but it certainly has been a bit choppy around the Samsung and SK Hynix sort of earnings, blowout earnings. But investors did at one point sell the stock quite a bit here on the news and really on those results. Indonesia is still the key focus here today. They seem to be trading once again here after that trading halt, but we're still seeing outflows and declines of more than or close to 6% this morning. Rupee still around those record lows, and we're still watching, of course, Brent prices given the concerns around Iran this morning. We're trading around $69 for Brent. Of course, we're talking about what goes on in China as well, with UK Prime Minister Keir Starmer has met with Chinese President Xi Jinping in Beijing and calling for a, quote, more sophisticated relationship between their countries. It's the first trip to China by a British leader in 8 years. Let's bring in our China correspondent, Min Min Lo, on really the tone that was struck from Keir Starmer heading to China.
Yeah, it's pretty positive. He brought with him a match ball from the recent Premier League match between Arsenal and Man U. He gave that as a gift to President Xi. And we know the British Prime Minister is a fan of Arsenal, but President Xi is a fan of the rival. So is that reflective of the relationship? I think Keir Starmer is really there to change that, because he's been, one of his first remarks after he arrived was to talk to the delegation that accompanied him. He spoke at the lobby of his hotel, and he said they are making history because he's really trying to change this relationship. He has talked about how the Tory government really brought about an ice age, between UK and China. And he has been facing a lot of pushback from UK's China hawks, right? And he is still pushing with this two-pronged approach. On the one hand, acknowledging the national security threats that China poses, but on the other hand, really wanting to improve economic ties with China, especially against this backdrop where UK is experiencing high inflation and a shrinking economy.
In terms of outcomes, what are some concrete things that are expected?
So no deals has been announced yet, but we are still waiting for concrete details. We'll be looking out for size and scope. Analysts are saying that any deal will likely fall short of a comprehensive free trade agreement because that will likely, provoke some sort of response or retaliation from President Trump. But we could see maybe piecemeal or company-to-company agreements. We know that the top power company in the UK is expected to enter into a strategic partnership with a Chinese power company. And this is a very major foray into a sector that for a long time has been tightly regulated. And Keir Starmer brought with him 60 people representing sectors from financial services, medical, pharmaceuticals, manufacturing, looking for greater market access in China. And of course, there's the other bucket, which is the geopolitics. There's Taiwan, Ukraine, human rights, Jimmy Lai. These are the areas where we are less likely to see forward progress.
All right, Min, thank you. Min Lo, they're our China correspondent on what to expect. And let's get more on Starmer's China visit with Michele Geraci, former Italian Undersecretary of State in the Ministry of Economic Development. His expertise spans global trade investment, U.S.-EU-China relations, and the Belt and Road Initiative. Michele, it's great to have you on the program. It seems like Beijing has been rolling out the red carpet for many Western leaders of late. You talk about Mark Carney, the first Canadian Prime Minister to be there in 10 years, Keir Starmer as well. Why do you think this is all happening right now? Do you think that there is a change in attitudes from the West when it comes to China now?
There is indeed a change, and I see this also in Italy, where I'm from, because most European leaders have finally realized that the U.S. is not such a reliable partner, at least from a trade and economic point of view, than it used to be. So, of course, naturally, both Mark Carney, Keir Starmer, Macron, German Chancellor Merz, and even Italian Prime Minister Meloni are looking at China not as a geopolitical alternative. All these countries will remain in the NATO military alliance. That's not in discussion. But of course, the economy here in Europe is not very strong. And of course, they're looking for partners. And they're looking at India, they're looking at China, they're looking at the global south, the BRICS country, the Belt and Road countries. And the US should not really stop this trend. The US itself is the country that wants to do first more business with China. So there is no geopolitical disconnect between what the EU leaders are doing and the UK leaders are doing with what Trump himself would like to do, which is increase exports of made in USA goods. So what Keir Starmer is doing today here in China is simply try to help his own company to sell and do more business with China and maybe attract more Chinese investment going back.
Yeah. He mentioned he doesn't want the UK to choose sides between the US and China. He's not going to do that. But then again, how does warmer ties with the UK and China, do you think, can it actually withstand some of the trade threats from the US here? What can actually be achieved, do you think?
Well, he's right. In terms of economic relationships, in Europe, our economies are pretty much market economies. And yes, while the relationship between head of state, head of government is important, ultimately, it is not China selling anything to the UK or anything the UK sells to China. It is individual British or Chinese citizen and company choosing to buy and sell things from each other. So in a way, a UK company that wants to sell its products to both US consumers and Chinese consumers does not have to choose a side. And in that sense, there is no conflict in this having to choose sides with doing business with both ends of the world. So I think that's quite natural. And as I said, it is in the interest of its company. Head of states and the head of government need to do the interests of their own citizen. They are not working for NGOs that look at issues like human rights and what happens inside other countries' boundaries. Their job, they're paid by their own citizen to take care of the economic and social development of their own citizens. And I think Keir Starmer, like Mark Carney, are doing a good job without breaking the relationship with China. I'll give you an example. You mentioned I was the one that pushed Italy into the Belt and Road, and people said, oh, but this will destroy the relationship between Italy and the United States. Actually, this did not happen. Italian exports to the US grew by 40% while Italy was inside the Belt and Road. So US consumers, US company, of course, continue to do business with the Italian company, even when Italy was, let's say, pivoting to this BRI project.
Interesting. Good point there. When it comes to, this is against the backdrop of the EU, as von der Leyen say it, right? It's not, agreeing to this mother of trade deals with India as well. Can you tell us a bit more about what was driving these two to come together? I mean, is it still also a counter of the U.S.? Is it a way to countering China as well? And how do you see this kind of new world order shaping up now?
Okay, so first of all, the New World Order, that we don't know what it is because it's new, it's basically a recognition that the world economy is not going to be Europe or US dominant. So the hegemony of the US is relatively going down. We're not talking about the de-dollarization. This will take time. The US still remains a large economy, dominant, but relatively speaking, the BRICS, China, India, and the rest of the world, Southeast Asia, ASEAN, will of course gain relatively in importance. So that's a fact. Now, the European Union adds a little bit of its own ideological, and this is where maybe the problem comes into play. The job of von der Leyen is basically to try to sign as many as free trade agreements as possible with any country in the world. I know for a fact that there were no real deep analysis of cost and benefit of this trade deal with India. Many people in Europe are worried that, of course, India is an economy that has low wages, and of course, competition from China, Indian products may affect negatively European companies. So no one knows really what this deal is going to bring in terms of economic benefit, because it is important also for the audience to remember that free trade agreements are a really different animal from simply lowering import and export tariffs to each other. China does not have any free trade agreement with the UK, does not have any free trade agreement with the US or with the European Union, but trades a lot and has a surplus with each of these countries. These countries benefit from beneficial trade without having a FTA. Now, the EU with India doing a free trade agreement is something that is a little bit dangerous because it comes with not just lowering tariffs, but also standards, labor rights, investment, reciprocal agreements. So it's much more complex. So I tell you, put my hat as a professor, there is really no theory that says that free trade agreements bring benefits, while there is a little bit of theory that says that actually trade does bring benefit. But free trade agreements, inside that, there is much more than just trade, and that makes the analysis a little bit more complex. So just to make the point clear, it is an ideological push which lives inside the heads of people in Brussels. They just want to leave the office having signed as many as FTA agreement as possible.
Okay, so would you say that this trade deal is a hedge against China then, between EU and India?
Well, it's difficult to do a hedge because China and India are two different economies. One is one is $20 trillion economy. The quality of development stages is also very different. The GDP per capita is different. So you cannot substitute China. China is the country that has most advanced technology, most advanced semiconductor. And of course, China itself is part of the BRICS with India and wants to do business with India itself. So it is impossible to, let's say, risk decouple from China. It is fine to give our company some opportunity to do more business in India, but I've been in India many times in my role as a former Undersecretary of State. It is a very difficult market. There are different, the economic situation in each of the many states in India, and the European company will find, except maybe for UK company that of course are outside the EU, generally EU company will find very difficult to do business in China. So I think this trade agreement with India is more of a political thing that von der Leyen puts her name on, rather than something that will bring practical effect. And of course it will take 10 years before it is actually fully realized. And by then China will accelerate its development further.
Okay, so maybe it's just largely symbolic. But as you mentioned, right, there are divergent views that the EU and India has when it comes to China and Russia, for example, too, right? I think the EU sees Russia as a direct threat, but they're willing to, still engage with China. India, on the other hand, it continues to want to counter China in some ways, but also pressing relations with Moscow. So without a unified strategy, I mean, it doesn't seem like the Russia issue still seems to be a kind of a main sticking point.
It is true, and you're right. India, of course, since 2022 has almost has imported oil from Russia at a rate that is almost 6, 7, 8 times more than it used to be before 2022. So India has basically said, like I said, Modi's job is to do the interest of his own Indian citizen, not the interest of European and not the interest of Ukrainian or China. He can buy oil at a relatively good price from Russia. It can crude oil, he can turn into oil products and then sells them back to Europe. So it is higher GDP for Russia that sells more oil, higher GDP for India that buys at a good price, higher GDP for India that reprocesses it inside, and higher GDP for India that exports it to the EU, to the European Union. For the European Union, all these sanctions is a negative impact on our own economy. Now, you said that Russia is a threat to the European Union. I don't think so, and I've been trying to tell this clearly. I was in Russia recently. I met with many members of government. Yes, there is a crisis and a war in Ukraine, which they see in Russia as a civil war almost. It's something their own business. Russia, Ukraine, and Belarus are kind of separate things. There is no immediate threat from Russia into the European Union, and this is again the view that the European leaders are beginning to understand and realize. Russia is not going to go to Berlin again like they did when they freed Germany from the Nazis. They're not going to Portugal. They're not going to bomb London. Even Vice President Vance of the United States said that the threat for the European Union does not come from China, does not come from Russia. Now, this is not a pro-Russian, this is not the Pravda newspaper saying, this is the Vice President of the United States telling European leaders in Munich last year, guys, your own problem, you guys, European problem is inside yourself. It's not coming from external threats. And German leaders are realizing that the sanction, the blowing up the Nord Stream, we don't know who did it, but surely it was not Russia, is not having any impact whatsoever on stopping the war, as we knew 4 years ago, because sanctions never work to stop wars. And the German leadership is realizing that their survival depends on cheap gas from Russia. So they are now looking back and say, well, for 4 years we've been suffering. The German economy is a disaster. It's dragging down the whole of European Union economy. And now, I know it's difficult politically because they've invested so much capital, but the thing they need to do is to start buying oil and gas, specifically from Russia, again. And I know it's hard to swallow, but this is the real politic. Merz is paid by the German citizen to help German citizen, not only to help Ukrainian citizens. For that, it's a side thing the government needs to do also to take care of world peace. But the main goal, 90% of the job must be done to serve their own people.
Yeah. That could be one hard to swallow there, but we have to leave it there. Michele Geraci there, former Italian Undersecretary of State, Ministry of Economic Development. Meanwhile, we're talking about Canada. They're saying that energy and critical minerals will be the cornerstone of new trade ties with India as the two nations rebuild relations after a diplomatic rift. The Canadian Energy Minister, Tim Hodgson, told us that at the India Energy Week in Goa about their deal to expand trade in oil and gas.
Well, let's just start with LNG. So it's a relatively new product for Canada. Our first major plant started production this June. It's a 12 million ton per annum plant, one of the larger plants in the world. The companies behind that are Shell, Petronas, Kogas from Korea, Mitsubishi from Japan. and CNOOC from China. So all those countries find our LNG to be competitively priced. I believe India would find the same. Between now and the end of this decade, we expect to ramp that production from the 12 million tons per annum to almost 50 million tons per annum. So there's a tremendous opportunity, we think, for India, which is a large consumer, to find a reliable new supplier. As it relates to oil, we now have a pipeline to the West Coast that is almost 1 million barrels a day. It is significantly shorter to ship crude from our West Coast to India than it is to go around the Gulf Coast. Many of your refiners are actually buying our crude off the Gulf Coast in the U.S. We're now offering them the opportunity to buy it off our West Coast, which should be ultimately less expensive because it's closer to India. We're in the process of expanding that pipeline by another 400,000 barrels a day. And the province of Alberta, which one of the ministers is here with me, is working on a proposal to develop another 1 million barrel a day. So that would be almost 2.5 million barrels a day of Canadian crude off our West Coast. I'd put that against today. I believe I heard that your total demand is 5 million barrels a day. So this is a very significant new source of supply. And what I've also heard from your refining companies here is a lot of new investment has gone into your refining sector, significantly increasing the capabilities. And as they increase the capabilities, one of the most attractive forms of crude is a heavy crude, which is what Canada offers. So we're excited that your refinery industry is growing. We're excited that as it grows, our oil becomes more interesting to your refiners, and we're excited that we can be offering it to you off the West Coast on what should be a cheaper source of supply.
What portion of India's purchases do you think Canada could be over the next 2 to 5 years?
Let me just give you some rough numbers. Today, we provide less than 1%, well less than 1%. When I look at Canada's production of oil in the world, we're 6 or 7% of the world's production. We're supplying less than 1. We produce 6 or 7. There's a lot of opportunity to just get to what would be a normal relationship. I think that's an opportunity for someone who thinks it's a buyer's market. I think as a supplier, I'm excited to find an interesting new buyer.
That was Tim Hodgson, their Canadian Energy Minister, speaking to Menaka Doshi in Goa as well. And as we've been talking, when it comes to energy prices, we're checking, of course, the base metals here once again. You take a look at how copper is doing in the LME contract, extending that surge, and we are trading above 14,000 for the first time. So a record once again for copper. Obviously, there's been a lot of expectations about this, stronger U.S. growth, more global spending on data centers, robotics, power infrastructure, all themes that we were talking about on Insight here today. So certainly that is one to watch. It is moving some of these copper stocks as well. Take a look at Hindustan Copper is up 16% in India here right now. Rio Tinto and BHP all higher by more than 1%. We got plenty more ahead. This is Bloomberg. Well, Chinese property stocks have surged today after a local media report signaled a potential easing of regulatory pressure. Sources also tell us that at least 3 developers had stopped filing regular reports to regulators around 2023, while others suspended reporting from early last year. And this is the last trade before that lunch break. Double-digit gains for most of these developers here right now. Let's bring in our Asia credit reporter, Trista Xingli Luo, for more. Obviously, it's just reports right now, but how significant would this be?
Yeah, so if we recall the three red line, this metric were introduced back in 2020, and it's part of Beijing's key effort trying to limit debts and trying to ensure those developers have enough cash to cover short-term borrowing. But it quickly turned as a turning point for the once booming property market in prompt a trigger around 130 billion of default we can see on China Evergrande, on Country Garden, and right now recently we see the struggle of China Vanke. But really the report saying the reporting requirement is not that newish, and analysts are telling us it might have greater impact on the market sentiment than the actual implication.
Yeah, maybe just the headline grabber there, just given that three red line. We haven't said that in a very long time, but as you say, right, a lot of developers have already gone into default. Actually, there's no need to really implement it anymore, as some say, right?
Yeah. So I think we can see equity outlook a lot, but for the bond market, it actually pretty muted. So which means that credit investors are still pretty cautious about this kind of headline, and you really need to look at the fundamental of the developer, right?
Speaking of some developers, you've been tracking the updates with Vanke. So they seem like they have a bit of a lifeline right now from Shenzhen Metro. Tell us a bit more.
Yeah, so Vanke got a shareholder loan from Shenzhen Metro, its biggest shareholder. We see from the filing earlier this week, and that loan could help them to pay back 40% of principal for 3 bonds, yuan notes. So that will help them to avert the imminent default, and it will buy them more time because their next bond maturity will be in late April. So they will have more time to maybe come up with a holistic restructuring plan.
All right, Trista, thank you. Trista Shinui-Luo, their Asia credit reporter. Before we go, we have some earnings to tell you about here when it comes to South Korea. So Hyundai Motor, of course, one of the big weights on the Kospi here. Operating profit for fourth quarter, 1.7 trillion won. That is about a 1 trillion won miss from the estimates there. So we'll track, of course, how the market reacts to that. That's it for us here on Insight Horizons Middle East, and Africa is next.